Welcome back to Investing Talk Podcast.
Today we're looking at Redwire Corp. The big question is it a good time to buy now?
We want to hear from you. Subscribe, like, and comment to support the show. And if there's a specific company you want to look into, leave it in the comments below.
So let's get into the analysis. Look, this one's a real head-scratcher, isn't it? A classic growth story versus some seriously concerning financials.
Exactly. You've got this company right in the middle of the space boom, doing really specialized, critical stuff, huge potential.
But then you look at the numbers, the actual results, and it gives you pause, a lot of pause. So we need to figure out if that upside is worth the very real risk right now.
Okay, let's start with the good news then, the bull case. Because, the growth is impressive. That's what gets everyone's attention.
Right. Let's talk revenue. Full year 2024, they pulled in $304.1 million.
Which sounds decent, but the key is the growth rate, isn't it?
Absolutely. That $304 million, it's up 24.7% from the year before.
Wow. Okay, nearly 25%. In aerospace and defense, that's really flying. Most companies in that sector grow much, much slower.
It suggests they're either grabbing market share fast or maybe benefiting from this ramp up in government space spending, or both.
And it's not just any space stuff. They're known for specialized infrastructure, right? Like the really complex bits.
Exactly. We're talking advanced avionics, sort of the brains for satellites, and deployable things like sophisticated solar arrays, composite booms, that kind of hardware.
So mission-critical components, the stuff that has to work.
Pretty much. They're building the essential guts and, you can say, the skeleton for next-gen spacecraft, especially for national security and defense customers.
And that's where the moat comes in, I guess, their competitive advantage.
That's the idea. Once you're deeply embedded in these national security contracts with your specific tech, it's really hard for someone else to just jump in.
How so? What makes it so difficult?
Well, think about the certifications needed, the integration process. The government isn't going to switch suppliers for critical systems easily. It's incredibly expensive, complex, and frankly risky for them to change horses midstream.
Okay, that makes sense. High switching costs. They're selling solutions, not just parts off a shelf.
And that position lets them potentially ride some massive waves. First, the big increase in U.S. government and defense spending on space, that's happening now.
Right. Then second,
those more futuristic fields. Things like commercializing low Earth orbit, think manufacturing in space, biotech, maybe unique materials you can only make in zero-G. Redwire could be providing the infrastructure for that too.
So the long-term story is compelling. If you believe in this multi-decade space cycle, Redwire looks like a key supplier, right?
That's the bet investors are making. They're looking past the current difficulties. Betting Redwire becomes essential infrastructure for decades. That's why the valuation might seem high relative to current profits.
Okay, keyword there. Current difficulties. Let's pivot to the bear case. Because while the growth is great, there's this giant red flag on the financial side.
Yeah, this is where the bullish story hits a wall. Profitability, or rather, the lack of it. Despite that fantastic revenue growth, Redwire is losing a lot of money.
How much are we talking?
Well, in 2024, their net loss actually got worse, reaching over minus $155 million. But the truly staggering number, the one that makes you really sit up, is the margin.
Go on.
Trailing 12 months gross margin.
Yeah.
It's sitting at just 2.53%.
Wait, 2.5% gross margin?
Yep. 2.5 cents left from every dollar of revenue before you even pay for R&D, sales, admin, everything else.
That's incredibly thin. How can a company even operate like that? Is it sustainable?
That's the core question, isn't it? Why so low? Maybe they're bidding super aggressively on complex government jobs just to get locked in, sacrificing profit now for future work, building the moat, but paying heavily for it. Or maybe there are just serious inefficiencies. Trouble managing costs on these very specialized, difficult contracts. It's hard to tell from the outside, but the result is the same.
And that filters down to the bottom line, obviously.
Massively. The trailing 12-month net margin is a mind-boggling negative 95.5%.
Minus 95%. So they're losing almost $1 for every dollar they bring in.
Effectively, yes. And the total net loss over the last 12 months, almost $250 million. Minus $249.54 million.
Wow. Okay. Burning cash like that.
Yeah.
How long can they keep it up before they need to raise more money?
Which could mean dilution for current shareholders, right?
That's the constant worry. And we actually saw the impact of this pressure recently. Remember the Q2 earnings back in August? That was
not good.
Boy.
Refresh my memory. What happened?
They missed revenue expectations pretty badly. Came in at $61.76 million, which was actually down almost 21% year over year, a sharp reversal.
A decline. after all that growth talk.
Exactly. And the losses were way deeper than analysts expected, too. EPS was minus $3.25. Ouch. What was the reason they gave for the revenue miss?
Contract delays. Those crucial government and defense awards got pushed out. Revenue they expected in 2025 is now looking like 2026. That shook confidence, understandably.
Yeah, relying on big, lumpy government contracts always carries that risk of delays. It really highlights the challenge here. Huge potential demand, but real struggles turning it into profit today. Execution seems key.
It's this painful paradox. Great long-term story, but maybe high costs, maybe execution issues are preventing them from making money right now.
So fundamentals are challenging, but often near-term catalysts can move a stock like this. What's coming up?
The big one is Q3 earnings. That's scheduled for November 6th, just around the corner.
And what's the market expecting? Another disaster?
Actually, no. The consensus is pricing in a massive improvement from Q2. Analysts are forecasting an EPS of around minus $0.12.
Minus 12 cents. Still a loss, but compared to minus $3.25 last quarter, that's a world of difference.
Exactly. If they hit that, or especially if they beat it, you could see the stock react very positively, very quickly. It's a huge swing factor.
And what are analysts saying overall, beyond just the next quarter?
This is where it gets really interesting. Despite the recent problems, the consensus across all the sources we looked at is still buy, unanimously.
Really? Hey, unanimous buy. What about price targets?
The average 12-month target is up at $17.21, which, from where the stock is trading now in late October, implies, what, something like 115% upside?
Over 100% upside potential, according to analysts. That's bold, considering the risks we just discussed.
It is bold, and that optimism is clashing hard with some very immediate destabilizing factors. Just look at what happened in October.
What specifically?
Major leadership shuffle. The CFO, Jonathan Bailiff, the guy steering the finances through this tough period, announced he's retiring, effective November 30th.
The CFO leaving right before a critical earnings report and amidst these financial struggles. That doesn't exactly inspire confidence, does it?
Not really. The CFO change right now raises questions about stability, especially when cash burn and potential financing needs are such big issues.
Anything else?
Yep. Big shareholder move. Early October, a Bain Capital affiliate, they were a major backer, sold off a huge block of stock. 10 million shares.
10 million shares. How did the market react?
Stock dropped over 8% pretty much immediately. When a big, informed player like Bain heads for the exit, it makes other investors nervous, regardless of the long-term story.
Understandable. So, leadership changes, a major shareholder selling. What else?
Legal headaches. Remember the Pomerantz law firm investigation? That's still hanging over them. Potential securities fraud, business misconduct related to those guidance withdrawals and revenue misses.
Okay, so it's a perfect storm almost. Financial stress, management turnover, insider selling, and legal scrutiny all at once.
It feels like a very high-stakes moment for the company, a real balancing act.
All right, let's shift from the news to the charts. What are the technicals telling us? Is there any sign of stability?
Well, the stock definitely took a beating, pulling back hard from its highs. But it does seem to have found some footing, some support, down around the $6.61 sub level.
And where is it trading now?
Currently bouncing around the $7.95 to $8.21, so off the lows.
Any positive signs on the chart?
Importantly, it's managed to climb back above its 50-day moving average. Technicians often see that as a short-term bullish signal. Suggests maybe the recovery attempt has legs, at least heading into earnings.
What's the next level to watch on the upside? Resistance.
The immediate hurdle looks to be around $9, if it can break through that convincingly, especially on good volume.
Then maybe those higher analyst targets start looking a bit more achievable, like $12. Then maybe eventually that $17.
Potentially. But wow, you need a strong stomach for this one. We have to mention the beta.
Ah, yes, volatility. What's the number?
It's high, 2.48.
Okay, translate that. What does a beta of nearly 2.5 mean for someone holding the stock?
It means expect wild swings. Extreme volatility. If the overall market, like the S&P 500, goes up 1%, Redwire is likely to move about 2.5% up.
But if the market goes down 1%...
Redwire could easily drop 2.5% or more. It magnifies market movements significantly. It's definitely not a sleep well at night kind of holding for most people. Think rocket booster, high thrust, but also high risk.
That volatility probably reflects the conflicting signals we're seeing, right? Even among big investors.
Seems likely, because despite that big Bain Capital sale in October, the data shows that overall, large institutional investors, the pension funds and the mutual funds, actually increased their positions in Redwire during 2024 and into 2025.
Interesting. So while one big player got out, the big money in aggregate has been buying more.
Apparently so. That suggests the institutions that can ride out the quarterly bumps, the ones focused on the long game, still believe in that multi-decade space thesis.
Okay, let's try to synthesize this. If someone's listening now trying to decide about Redwire, what's the takeaway based on their investment style?
Right. Well, if you're thinking short term, maybe a trader. This is all about that November 6th earnings report.
A gamble on whether they beat expectations and maybe announce some contract wins.
Pretty much. High risk, potentially high reward, based purely on that catalyst and the current volatility.
And for the long-term investor, the one buying into this space story.
You get exposure to that huge potential market and Redwire specialized tech, that moat we talked about. But you absolutely cannot ignore the immediate critical risk, that massive cash burn. The minus $249 million TTM net loss, those razor-thin, frankly unsustainable margins. If revenue growth falters at all, or if they can't get costs under control and burn through cash even faster, the downside is severe. Dilution, further share price drops. It's very real.
So wrapping up, the next 3 months or so feel absolutely crucial for Redwire.
Definitely a crucible of volatility, as you put it. You've got the earnings risk on November 6th, the CFO transition happening right after, the legal issues simmering. It's a lot.
The whole investment hinges on one key question, doesn't it?
I think so. Can that rapid revenue growth everyone expects, analysts are forecasting like 93% next year, finally start translating into believable improvements in profitability? Can they prove the moat is worth the current financial pain?
Or do the governance issues, the execution problems, and the cash burn win out over the long-term space dream? That seems to be the central question investors need to answer for themselves right now.